Tonight, discover the secret power of expected moves in today's market. I'm Don Kaufman. Again, a couple things right up front. Risk disclosure. We're not financial advisors, nor are we a broker-dealer. We always throw this up here because, well, that's kind of where I got a big portion of my career. So I started trading in Chicago in the late 90s. A short time thereafter, I joined a little bit of a startup firm called Thinkorswim, and I ended up running the education division. I was one of the younger people at Thinkorswim, so they said, "Hey, you're young, you don't know any better. You want to go fly around the country?" And yeah, sure. I mean, it beat being like in a trading floor with no windows. There literally was no windows. It was always dark. I figured I'd fly around the country a little bit. So that's kind of how I got my start. And subsequently, we were there until, of course, took Thinkorswim public. We were eventually acquired by TD Ameritrade. But again, 20-year trading career now. I throw the copyright disclaimer up here mainly because it has our email address. We do answer emails. We use a common inbox. You ever need to get a hold of me after tonight, it's just support@theotrade.com. Support@theotrade.com. And for those of you that know us, yeah, we answer emails. Somebody was like, how did you guys end up in Arizona? Once again, Chicago kind of sucks in the winter. It's okay to say that. It's okay to say that. And I had lots of family that had retired as traders. They had retired to Scottsdale. And I was out here as a kid a ton of times. And I was like, that place in Scottsdale surely beats living in Chicago in February. I started coming out here. Next thing I know, yada, yada, yada. 3 kids, married for a while, living out here. But I was still running, at the time, I was still running the education division of TD Ameritrade and their 7 million clients. So it's a little bit of a background on me. I did the CNBC tours for years. I always throw this one up here because, again, if you're going to be pitted against somebody, Mr. Wonderful is the guy you want to be pitted against. All right. It's fun. It's memorable. A little bit about TheoTrade. So off myself and on to TheoTrade. We specialize in education for stocks, options, and futures. Everybody, in terms of the educators here, have a minimum of 15 years of active trading experience. A couple of us with a few decades behind us. And we're always here to discuss, first and foremost, how do you mitigate the risks in the market, and then come down to a skill set that can last a lifetime. The other thing that's really important, at least to me, and I think it should be important to you as well, but TheoTrade is not just Don. It's, again, we now have 7 full-time instructors here. So these are the TheoTrade instructors. So we have Jeff Bierman. Okay, for those of you that know or don't know Jeff Bierman, Jeff actually works side by side with me at both Thinkorswim and TD Ameritrade. If you're on the Thinkorswim trading application, many of the chart studies on there, he's the main guy. I mean, he helped build the Thinkorswim charts. Matt Williamson, one of our newer instructors, market neutral premium selling and option strategist. This is for people that don't like market direction, just want to sell premium. We got a guy for that. We got a guy, Corey Rosenblum, senior strategist and swing trader. He's our resident swing trader. Then we brought on Steve Slim Miller. Cyclical analysis is really his thing. So if you're into waves and so forth and Fibonacci's, 43-year, though, veteran, huge career on the Chicago Board Options Exchange floor prior to, of course, retiring off the trading floor, and now working here with us at TheoTrade. Last but definitely not least, Tony Rago, NASDAQ futures and intraday strategist. We also just brought another individual on board, which is Brandon Chapman. Haven't even had time to add him yet to the slide deck, so we are up to, again, 7 instructors, including myself. Now, this is something that I like to throw in a lot of different slide decks that I use. And I don't say this to be disparaging, but I do say this because, I've been around this business for long enough, right? And, people have tendency to want what I kind of call instant coffee and instant tea. In fact, I put that into the slide. This ain't instant coffee and instant tea, okay? What we present here at TheoTrade, right, isn't like a magical, what I call magical mythical beast, right? We're not going to be, it's a secret proprietary system. Forget all that crap. Because it doesn't exist. Because if it did exist, listen, I used to, at the time I was there at TD Ameritrade, we were a $20 billion company. Do you think if somebody had like a bouncing ball with red and green flashing lights that told you the direction of the market, they would have bought it? I'd buy it now, okay? But you know what? It doesn't exist. And if you really want to learn this business, you're going to have to be willing to put forth some effort. Okay, as I said, it's not instant coffee, instant tea. You're going to have to learn something. And what we're going to discuss, it's about, hedging activity and really recent market structure. Okay, all of the above over here. And I want people to know that. So this is going to be a little bit more demanding of you. You guys okay with that idea? Because again, people get real frustrated. They're like, wait, you mean this is not going to be red and green flashing arrows? No, it's not. And it's not going to be the magical, mythical, Fibonacci over there. So let's get into it. All right. Volatility equals risk. So volatility equals risk. Option markets can really be thought of as putting a price tag on risk. So I got it out of there right up front here when I say option markets, and you're like, whoa, no. Don said I said the O word. Option markets could be thought of putting a price tag on risk. And, first of all, if you don't trade options, that's fine. For this evening's conversation, it's absolutely fine. But what you're going to find is that even if you don't trade options, I urge you, okay, to pay attention this evening, because options are going to dictate to you what the entire marketplace sees as risk. So pricing in markets is determined via market participants. Ultimately, option pricing, it just comes down to supply and demand. And competition breeds efficiency in pricing. And what that means to people get like really overwhelmed quickly with this stuff. When you look at the price of an option, let's say an option is trading at $1, okay, at $1.05. That's a market, right? What that means is if right now you wanted to buy that option, you could buy it for $1.05. And if you wanted to sell that option 2 seconds later, you could sell it for $1. Okay, that's the market. And you can be both a buyer and a seller in that market. And again, how is this market really priced? It's priced by supply and demand. But the options market is really, it's dictating to you like what that risk happens to be. Why is the option trading for $1? Why is the option trading for $1.05? Okay, because that's what the market thinks the movement in that particular underlying is going to be. Now, let's go a little bit further into this. We okay? Because we're going to get a little crazy tonight. We're going to talk a bit about implied volatility. Now, this is a slide that I've used for, decade or two. It's just a quick review of implied volatility. If you know it, great. If you don't, here comes a crash course in implied volatility. All right. And this is where I usually look for, the questions start pouring in. It's all right. Even if you're listening to this, on a recording, right, you're probably going to have some of the similar questions that are going to come up live. So I will answer them with implied volatility. First of all, people talk about volatility like till they're blue in the face. And most of them have no clue what volatility is. There's two types of vol. You got historical vol. Okay. You're like, okay, what's historical vol? All right. And we're going to cover a little bit about the different types of implied, okay, versus historic for a second. So again, historical volatility, it's the annualized standard deviation of past stock price movement. What does that even mean? Okay, it means actual stock price movement when the stock's moving up and down, and that's a type of volatility. Then we have implied volatility. Now tonight we're going to focus on implied volatility because implied volatility is what the options market is saying about risk. And it's important. Okay, it's really important. So here's a stock, and the stock is trading right at about 100, right? And the volatility happens to be just about 20%. Now, what does volatility really mean? It means standard deviation. Now, this is where people are like, oh, I don't like this entire idea. So let me explain what I just threw onto the screen because it's a bit to comprehend right off the bat, but the volatility, for example, is 20%. And again, lots of people kind of know what vol is. They sometimes talk about the VIX. Where's the VIX right now? Well, the VIX is at 10, but this stock has a volatility of 20%. This stock could be like Google, although Google is not 100, but let's just say it's a stock and the stock's trading at $100 and the volatility is 20%. What that volatility really kind of correlates to is, movement. Now, some people call it movement. Some people call it expected move. Tonight, we're going to be talking about expected move, right? In the real definition, though, is what we call standard deviation. And I don't want to go over anybody's head here, but here's the bottom line. With a 20% move, it means if you have a $100 stock, it can move up about 20% or it can move down about 20%. And it's supposed to stay in that range about 68% of the time. Now, the weird thing about this, and again, if this is the first time you've like ever really heard about expected move, you're like, oh, bestill my heart. It's a lot to kind of comprehend. But as you kind of look through this, right, what you got to know is how long is this good for? Like, it's supposed to move up about $20 or down about $20. And it's supposed to stay in that range 68% of the time. But volatility is always what we call annualized. That means this is supposed to occur within 1 year. Got it? Get it? Good. That's 1 year. Now, let me ask you something. And I think that this is a fair, this is a fair question. If you can figure out what the marketplace is doing from volatility, because we're looking at the volatility, and the volatility that we're looking at is the implied volatility. The implied volatility relates to the what? Relates to the options. So implied volatility relates to options. If the implied volatility is 20%, and then we can say 20% means, well, the stock is supposed to go up 20% or down 20%. It's supposed to stay in that range, X amount of time. And it's supposed to be within 1 year of now. Could we then extrapolate that forward? I don't want to use too big of definitions, but could we take that and move it forward and say, hey, forget 1 year. Could we divide that by 12 and figure out how far can this little monkey move every month? And if I can figure out how far it can move every month, can I figure out how far this little monkey can move within 1 week? And the answer is absolutely, unequivocally, yes. Sure, you can do that. That's what expected move happens to be. Now, we're getting a little bit, over our skis right now, but that's what you need to know. And the cool thing is, you're like, but Don, it only is equivalent to 68% of the time. What happens out here? And what happens out here? And my answer to you, don't worry, you're going to find out. That's the key to it. Okay. We can kind of like what looking at this is, it's handicapping how far the stock can move within a given period of time. By the way, it's deadly accurate. And that's one of the things you got to realize. It's deadly accurate. Okay. It's more accurate right now. Expected moves are more accurate right now than at any other time in the history of markets. And it has to do a lot with the efficiency trade. And that is, there's just trillions of dollars seeking returns. Now, implied volatility and expected price moves. So what does implied volatility delineate? Okay. What does it show? All right. It's volatility that justifies an option's current price. How can I use implied volatility in my day-to-day trading? You can extrapolate it into stock price movement, or what is termed expected move. I just wanted to throw some definitions out there. Now, people, we're having fun. Okay? All right. So expected moves. First of all, expected moves kind of explained in a little bit more detail. Let's throw up any other stock. Okay? We'll do one more kind of quick example. So we have a stock, and let's say that this stock, and I use this for every example, it's called stock, and that stock is trading, let's just put it at 200. Okay, so it's a $200 stock, and that $200 stock, okay, what is it capable of moving? So I'm going to show you in a moment. We have something called an EM. Do not forget this. I don't like to use like different acronyms because people get really lost in acronyms, but the EM, that is the expected move. That's the expected move. And the EM, let's say, is plus or minus $10. And that expected move is good for 1 week. Now, okay, we have an expected move of $10 and it's good for a week. What's it going to look like? It means that this stock can move up about $10, right? So it can move about to 210, or it can move down about what? $10, which takes us to about 190. Now, I can show you everything about expected move. I can show you even how to solve it. Okay. But what's important right now is that you're capable of discerning that this doesn't have a directional bias to it. Like the marketplace is just saying like, okay, equal chance of going up is equal chance of going down. And then it says we're supposed to move in that range how often? 68% of the time. You go, where'd you come up with the 68%? I pulled the rabbit out of the hat. Not at all. Okay. The rabbit didn't come out of the hat. 68%. That's what we call one standard deviation. It's a normal occurrence. Like everything you do in your life is, fits in a deviation curve. There's really, really good drivers and the really, really bad drivers. Then there's Los Angeles, which is somewhere down here. But most of us fit into the meat of the curve, right? So All right, yeah, I picked on LA a little bit. So the expected moves, pretty straightforward, okay? Now, as I go into this, this is what an expected move curve kind of looks like. So here's a $100 stock, and the further you go out in time, the more than stock can do what? It can move more. Now, again, the further we go out in time, it's giving it, all right, more chance to move. It's actually what we call a probability cone. This is what they call a probability cone, but it's the expected move. It says, like, in the next 30 days, we can move X amount. But in the next 60 days, we can move even further. In the next 90 days, we can move even further. All right? And here comes expected move and probability. Now, again, all we're trying to do right now is just define a little bit about expected move, understand some of the definitions, because we're going to use this in strategies here momentarily. So again, expected move, okay, defines a one standard deviation move in a given underlying. It's a 68.3% probability of an underlying closing inside the expected move by a designated expiration. That's it. That's all you got to know. Now, expected move calculation. So not every trading application has expected move. So this is where, all right, expected move calculation, people love to know this stuff, but I said not every trading application has expected move. But you can use what we term the at-the-money straddle as an alternative to expected move. Add the at-the-money call to the at-the-money put for any selected expiration. This is a nice way of kind of rounding it to expected move. Now, I'm going to show you in a moment. This trading application right here, it is Thinkorswim, but lots of applications around the industry these days, have expected move calculations built into them. But I don't want you guys to panic and be like, I don't have it, okay? Because I'm going to show you right now how to solve without it. The straddle price and the expected move. So I took this screenshot earlier today, and the screenshot was of Microsoft. There it is. There's Microsoft, okay? And you can see the expected move on Microsoft. And by the way, I picked a 30-day expiration. 30-day expiration, the expected move is about plus or minus $4. You can see it says right there, plus or minus $4 and change. Well, instead of using the expected move, just add, these are puts, okay, and add them to the at-the-money calls, and it comes out to about 390. Now, let's not split hairs. 390 is pretty close to 417, okay? 390 is fairly close to 417. And that's, it's really important that we know how to solve for this, okay, if we don't have it. By the way, somebody was asking about what we term market maker move. I hate that equation and I'll never use it, okay? I was one of the individuals that worked on this trading application and on these equations for years. And I spent 7+ years refining expected move, and I spent a tremendous amount of time in like the order entry on Thinkorswim and the Analyze tab. I mean, those are like the Analyze tab. It's my baby. It's my baby. And just refining some of the analytical tools on it. So when it comes to like the tools on here, you know, one of the reasons I show a screenshot of Thinkorswim, not because you need to be on Thinkorswim, it's because, you know, I'm related to it. Thinkorswim, that is. I'm absolutely related to it. I spent, you know, better part of from, I don't know, 2001 until 2015 working on it. So you kind of know the equations in there. So the EM equals expected move. The expected move has no directional bias. Expected moves, they're all based purely on implied volatility model. But you got to recognize that implied volatility is based on live markets, whereby there's often hundreds of millions of dollars setting the volatility in options and expected move. Hundreds of millions of dollars. Let me give you guys a quick example of some expected moves. So this happens to be none other than the spiders. If you open up the spiders in the very bottom of the screen, just look under today's option statistics. Now, listen, today, one of the slowest trading days we've seen in quite some time, right? It really was slow out there. This underlying traded 1.5 million contracts. 1.5 million contracts. You know, the entire market yesterday only traded 17 million. The entire options market only did 17 million contracts yesterday. I don't know what it did today. Probably did less than that today. It was brutal. Brutally slow day. That's okay, though. Okay? What I want you to know is the expected moves. We have expected moves for options that expire on Wednesday, on Friday, on Monday. There's now Monday, Wednesday, Friday expirations. See, look at this. This is an expiration coming up 5 days from now. Look, it has a $2 expected move. What that means, okay, is that this marketplace is supposed to move, again, up or down $2, $2, $2, $2. Now, okay, do you trust it? And that's where people are like, you should trust it. And I'm going to tell you why you should trust it. Okay, because there's billions of dollars. Look at this. There's 113,000 open contracts just at this one strike. That's a lot of contract size. That's just that strike, and that's in the spiders. You want to look at a big product? Go look at the SPX. Okay, the SPX, quote unquote, the mother of all products. And I'm not going to show you a bunch of bouncing balls and stuff like that, but look at this thing. Okay, it's huge. I mean, it's just like the amount of contract size. And then I'm going to take it a step further. Yeah, I'm going to go to a chart. How about that? I'm the guy that doesn't look at charts. And I am going to show you a chart because on my chart, I have all the expected moves hand drawn. And when people say, well, are we adhering to expected move? This week we did. This week we did. Okay, this week we did. By the way, we broke outside the expected move over here. Look at that. Is that really a breach? It's almost a rounding error. You've got basically 1, 2, 3, okay, 4, 5, 6, 7. All right. Here's one that we're outside. Here's one that we're outside. Okay. 8, 9, 10. All right. Look at all these weeks we're inside the expected move. And in this particular circumstance, you're going to learn real quick about 8 out of 10 times. This is actually upwards of 80% of the time we stayed inside what was expected recently. So if you ask about, the accuracy of it, okay, it is absolutely uncanny how we stay inside the expected move. By the way, I've got data, okay, going back years. All these are hand-drawn expected moves. And if you don't like that, well, how about this? I can pull expected moves now. If you're curious if this works in any underlying, well, we actually built a script for expected moves. And what the script effectively does, okay, what the script does is it'll actually automatically put expected moves into any underlying, so you don't have to hand draw them. And you can actually see when we breached, okay, the QQQ, that's the NASDAQ. The NASDAQ has stayed inside the expected move almost every single week. If you zoom in over here, you can see little tiny like blue and red dots, and those blue and red dots indicate when we actually traded outside the expected move. So trust the expected move. The thing is phenomenal. Now, real quick, cement boots. Math geeks and engineers, I'm kind of sworn to secrecy on how Thinkorswim derives the expected move. The Chicago River, it's cold, very dark place. So roughly, this is how you solve for expected move. You can find this equation anywhere, but this is the actual equation. Now, I'm not getting into detail. That's not, the goal tonight. The goal tonight is to take what we're learning in expected move and to apply it. And for the next 20 minutes, that's exactly what we're going to do. So using expected move can be a phenomenal resource. And please, that's an understatement. Okay, expected move, it's everything in options trading. It's everything in stock trading too. But this is where that rubber has to kind of meet the expected move road, right? Like if this is all well and good, you're like, okay, so he's telling me how far the underlying can move. No, okay, I'm telling you this is much more than just like, okay, the underlying can move. All right, let's get into it. Now, let us explore 2 strategies and 1 tactic to minimize risk, all revolving around expected move. So 2 specific strategies and 1 tactic to minimize risk. I told you this is going to be a lot tonight. I hope that that's okay with everybody because I'm not kidding. All right, it is going to be a lot. So here we go. First of all, I'm going to show you how to minimize the risk because you know what? It doesn't sound too exciting. You're like, I want to learn strategies. I got to tell you, I got to show you how to minimize risk first because, all right, I know that minimizing risk sounds incredibly boring. So boring. But without risk mitigation, you have everything to lose. Nothing to gain, you got everything to lose. People always say this statement like, you'll never go broke taking profits. That's a bunch of crap. It is. Because without risk mitigation, You're going to make profit, huge loss. In the next 5 minutes, I got 5 minutes to do this. I will exploit the areas of trading and investing and display where millions of people, lose millions of dollars. Good enough? Okay. The first step to put you on the path to success is to avoid some of the pitfalls in the markets. All we're going to talk about for the next couple of moments is stops and expected risk. Stops and expected risk. Listen, this is where we're really going to hit it hard right now. You ready? Okay, so we're going to go into a marketplace. You guys give me a stock. All right, seriously, give me any stock. And I hope that you guys make it something that's fairly, well, volatile if you want. Tesla. Is that a stock anymore? I don't even know. A lot of Facebook, a lot of Amazon. Okay. You know what? Let me start simple and then work to the extreme. I'm going to use, somebody came up with Microsoft in here. Disney. I like it. Oh, Caterpillar. By the way, Caterpillar, you're doing it for me. I love Caterpillar. In fact, I even have a Caterpillar example I'm going to show you here. I'm going to start easy. I'm going to start on Microsoft because I use the expected move of it. Okay. So as I said, what do we want to cover? Stops and expected risk. Stops and expected risk. Okay. I'll start with Microsoft. First of all, when it pertains to stop orders. Okay. How can you use expected move? How can you use expected move to not get stopped out? You ready? Because here we go. First of all right, if you look at Microsoft, this is the distribution curve. Let's say that Microsoft is trading right at 110. In fact, you know what? Bear with me here a second. I'm going to change color. I'm going to make it a little bit easier for you guys to see all these examples because one of the most important things is obviously learning this stuff, right? So here's my distribution curve. And let's say Microsoft is trading right at around 110. The expected move in the next 9 days. Why am I using 9 days? All right. I don't know. Maybe you put on like a short duration position. Okay. But in the next 9 days, there's this plus $2.30 or minus $2.30. And you know, okay, with a high degree of certainty, we're going to move within the range. Did you know that if you place a stop order, this is where I'm going to save you guys a ton of money. If you place a stop order anywhere inside the expected move, you will guaranteed to lose money in the long run. It's impossible to make money if you put a stop order ever inside of an expected move. I cannot stress that enough. And you're like, yeah, prove it to me. I am going to prove it to you right now. I'm going to come over here and I'm going to go what's called probability of touching. Now, probability of touching, irony, it's actually based off of the expected move model. Basically, what the probability of touching says, okay, the probability of touching is right here. It's the probability of touching a specific level anytime between now and expiration. Anytime between now and expiration. So what it basically means is if you put in a stop order, and for example, you put the stop order at 108, okay? What's 108? Forget about the option. We don't need to know the stinking option. We don't even need to know the price. The probability of touching is almost 65%. So if you were to do 100 trades and you like to put stop orders inside the expected move, you're going to get stopped out almost 65% of the time. Huh? Yeah. Not good, is it? Think about that for a second. Now, I'm going to throw you into another example really quickly. Because Tesla, so many people said Tesla closed down $9 today. Just look in the next 9 days, or better yet, let's go 30 days out. Let's go for it. Let's just go for it, right? 30 days out. The expected move is almost $50. $50 expected move. Now, people are like, yeah, I want to trade Tesla, and I'm going to put my stop order right at around 355. Okay? A 355 stop. Really? 355? You have a 78% chance of getting what? Stopped out. That's what probability of touching is. Probability of touching is based right off the implied vol, which is based on the expected move. Okay? That's the first thing that you need to learn about expected move. We having fun yet? Yeah? Okay? By the way, somebody wants to know what's the probability? What's the probability of Tesla in the next 30 days of this takeover being real? What's the probability? Well, the takeover price, okay, was what? It's about 420. The interesting irony, they're only giving a 25% chance of touching that level. Interesting. They're not giving a very high probability. Not giving a very high probability of Tesla truly being taken over in the next 30 days. Just wanted to throw that out for your consumption, because I'll tell you what, there's $1 billion says that this is right. Okay, billions, I should say, because 500,000 contracts traded in here today. 500,000 contracts of a $370 product. Now, the next thing I was going to cover, okay, that's a little bit about stops. Next, expected risk. What's expected risk? You're like, oh, you're going so fast. Okay, it's pretty cool, isn't it? Like I just showed you in literally, okay, 2 minutes, how you can say if If the stop order is inside your expected move, you're in big trouble. Big trouble. Okay? Now, we're going to get into what's called expected risk. What's expected risk? Let's cruise back over to Microsoft. Okay, here's the easiest example for expected risk. This actually, they teach market makers this really early on. They say, okay, in the next 30 days, let's use 30 days in this case, 30 days, Microsoft is supposed to move $4. So it's supposed to move up $4 or down $4. Okay, and then they say, what is the size of your position? And you say, well, I am long 1,000 shares. So I own 1,000 shares. That's supposed to say shares, but it's hard to write on the screen, man. All right, so it's 1,000 shares. Okay, what's your profit and loss variance? Huh? What's your profit and loss variance over the next 30 days? Now it's wide open, and I want you guys to think about this. That you're listening to this on a recording over here, but that's fine. Or if you're listening to it live, great. So when I say, what's your profit and loss variance? You're like, where are you going with this, Don? I'm trying to teach you to minimize your risk. If you know that a $4 expected move is going to happen, okay, you know that your plus or minus $4,000 is all but guaranteed. You're going to move that. It's 68% of occurrences are going to be in here. You're pretty much gonna make or lose $4,000. Does that help you position size a little bit more effectively? You know what's crazy? Okay, there's darn near 1,000 people logged on tonight. 2 people answered. Okay, I'm dead serious. 2 people answered that one. Nobody knows this stuff. So you know that you're going to make or lose $4,000. Let me ask you something. Are you comfortable with that? Are you comfortable making or losing $4,000? And then you can take what's called 2 times the expected move. What's 2 times the expected move? That's plus or minus $8. So kind of clear the screen for a second. The first thing you do is you actually do, okay, what's a variance of one expected move, which is plus or minus $4. Then you look at plus or minus $8. And if you have 1,000 shares, you need to be capable of taking $8,000 of risk. Okay, that is less apparent, but it's absolutely probable, okay, and plausible. And you can actually figure out how many shares you should be long or short by just knowing these. And again, I just wanted to scrape the surface, okay, of 2 huge areas that people continuously miss. Okay, stops and expected risk. They just throw money down the toilet. And I just throw this out here in the last 5 minutes. If you knew either one of those skills, how much money would it have saved you? In the last 5 minutes, we just exploited flaws that could have saved some of the people in here serious money. Now, not everybody that's tuning in tonight, not everybody, okay, necessarily trades. Some of you are more investors. But you think about this, it can help you with allocation. I mean, what would it be worth to spend a few hours on these topics and spend a couple of hours with me in a class to fully understand the skills, right? And listen, everybody in here, even if you're a little bit thrown off, you're like, oof, this stuff goes a little bit over my head, okay? Everybody comprehends the idea of okay, you just told me how far the stock can move within a given period of time, right? You told me that, okay? And then you told me wait a second, I can lose how much? I'm not comfortable losing $8,000. Good. Now you know you shouldn't be trading so large. Or that if you put your stop inside the expected move, okay, and you do, for instance, 50 or 100 trades over years, it could be years, that you will lose money. Okay, it's a mathematical certainty, and people don't really get that stuff. Even if you're right, it doesn't matter. You're going to get stopped out. I mean, when you look at this thing and you look at the probability of touching says 60%. That means you're going to get stopped out 60% of the time. Okay, that is worth a fortune to people. And I'm telling you, spend the time on this. There's a class that we did. It's called Essential Skills for Consistency in Trading. Now, listen, this is the risk, mitigation portion. This is how we minimize risk. This isn't even the strategies. I'm going to talk about strategy here in just a moment. But in this class, we talk about how to identify and correct flaws in your trading that prevent you from being a consistent trader. We talk about how to use the right trade logic. Trade logic is everything to approach your trading or investing so you know if the strategies you utilize can stand the test of time. That's what I call the law of large occurrences. You say, if I did this 50 times in a row, or if I did this 100 times in a row, does it work? And then we also talk about how you can use options pricing even if you're not an options trader or if you're an options newbie, and you can generate success as, whether you're a day trader, a swing trader, a long-term investor, if you understand just some really basic skills about stop orders and some basic skills about position sizing, right? Are we ready to move on a little bit? Okay. And again, I go real fast through this, but that's a class that it's ready. Like, we have that class ready, and it's a class that, I haven't really promoted it that much because, like, nobody likes the idea of, like, oh, I learned how to minimize my risk. Like, it doesn't exactly sound all that cool, sitting around, I guess, having a cocktail. You're like, hey, so I took a 3-hour class on minimizing my risk. But you know what? You have to do this. Like, these are the skills that separate, people that make money and people that don't make money. Let's get to number 2. Number 2 here is selling high probability spreads. Like, what the heck is that? So expected move provides the foundation. It's a foundation for selling spreads and collecting income. Expected move provides the foundation for selling spreads and collecting income. So we also did a class on this. It's Guide to Selling High Probability Spreads. I'll come back to that here momentarily. What I do want to show you is, okay, how else can I use expected move? So there were a few other underlyings that people mentioned, right? And I'm reading on the other computer. I'm on multiple computers, by the way. Was Elon's Musk move illegal? Okay. Actually, I don't believe so. I don't believe, like, people are talking about Elon Musk. I don't believe it was illegal. I think it falls under the Reed-Hastings law. And I happen to know a lot about securities law, spending, 15 years as a registered rep. He's gonna, be fine on that one. So let's go into another underlying. You know what? Somebody just mentioned in the chat, NVIDIA. Cool, works for me. So NVIDIA. All right, I'm a trader and I want to sell spreads on NVIDIA. When I say sell spreads, let me show you what I mean. Okay, I want to go out and, first of all, I have a tendency to want to look at the chart, and I know that earnings are coming up on here. Now, do you want to carry this through? Do you want to carry NVIDIA through the earnings? Let me get the expected moves off there for just a second. Do you want to carry the NVIDIA spread through earnings? Or, I got a good one for you. Maybe you put on the auto expected moves and you realize, you'll realize, look at this, NVIDIA is right to the upper edge of the expected move. And in the last couple of weeks, every time it got close to the expected move, almost every single time, it got close to the edge of the expected move, it actually bounced off of it. Meaning that, here, look back at NVIDIA. You would never know this if you didn't have the little study over here, right? Now here it closed outside of it, here it closed outside of it, stayed inside, stayed inside. Okay, this one mildly outside. All I'm showing you though, is statistical significance. In fact, I can even run, stats on this, and I can tell you how many times it touched it, how many times it exceeded it, everything. But even this week, if you knew where this expected move happened to be, do you realize you could just come in literally this week with 2 days remaining, and it'll actually say, hey, I could sell a spread right on the edge of that expected move. Hopefully that makes a degree of sense. Okay. Now I'm going to bypass NVIDIA for just a second, because NVIDIA, it's scary because it's got earnings. Ooh, scary. All right. So you can do that though. Now, let me kind of get in there. All right. And let's talk about another underlying. Let's talk about an underlying called Amazon, because that was the number one that came up when people were talking about, like, oh, what do you want to do? All right. Let's do something in Amazon. We know it's through earnings. Let's go. Okay. About 30 days out. This thing is plenty liquid. It's about 30 days out. And I'm going to open up a ton of strikes. I'm going to open up every single strike. Now, doesn't matter whether you're bullish or bearish. Doesn't matter. Okay. At a glance, the expected move is $90. At a glance, the expected move is $90. Okay. I know one thing. Probably going to want to go outside the expected move. Probably going to want to go outside the expected move. And we got a class specifically that teaches exactly which option to use outside the expected move. In this particular circumstance, all right, I'm going to go out and I'm going to sell, the 1980s, turn around and buy the 1990s. Now, people, this is a $10 wide spread. $10 wide spread for a $1.70 credit. How much risk do you have? A lot. $8.30 of risk. That is not exactly for the faint of heart. Now, this one happens to be a little bit more of a bearish spread. But all I had to do, okay, all I had to do to kind of corner where my spread is going to be laid, I went right outside the expected move. Okay, and I can't stress this enough. All I did in my head is I drew a little standard deviation curve, and I said, all right, I want to be right on the cusp over there. That's a big portion of it. Now, if you didn't like that one, good. Go do the puts. Okay, go do the puts. What could you do? You could sell these little monkeys. Apologize. You could sell these little monkeys, and for instance, buy these. Look, this is a $5 wide spread. Maybe you don't want to do a $5 wide spread. So make it wider. You do a $10 wide spread. This one's for $1.67. I mean, it's roughly the same thing. It's almost $1.70 credit. But we're outside the expected move. And you know what the cool part is? Okay, there's only a 43% chance that we're going to get touched out here. That is a very, very low probability of touching, right? And again, somebody was like, do you use delta to like select the strike? Maybe. Okay, absolutely. So again, when you're getting into this and you're starting to look at the expected moves, you guys getting where we're going with this? The expected move is defining things like stop orders. The expected move is defining, you know, what my risk management should be. The expected move is defining where I should probably be selling, okay, options outside of a particular spread. But again, the core of that is really taught. And all I'm trying to do here is just glance through some topics, all right? And those topics happen to be surrounding this idea of expected move and how imperative it is to understand. But we also did a class on this. It's called Guide to Selling High Probability Spreads. This is another one. This is actually a 4-hour class. We talk about how to sell the correct spreads. You maximize the benefits of time decay while minimizing your risk. What strikes an expiration period? That's what people want to know. Like, right, like, how far out do I go? Do I just go outside? What should be the right expiration cycle? What do I do around earnings? How do I identify my risk and reward? Like, all of that is what's really the nuts and bolts are covered in the class. All I want to get to tonight is what I'm actually using these expected moves for, okay? Or, for example, what you can actually do by looking at the expected moves specifically on a chart. Now, again, when I look at this on the study, it doesn't look like much. But you have to recognize that in an instant, you can pull up Amazon, and I just want to make this clear. You can pull up Amazon, and remember a while ago, we said, how often are we supposed to be inside of these expected moves? How often? 68% of the time, right? Okay? You want to see a little bit of magic? How about I went out here and I said, over the last 3 years, this is 3 years, you can barely see it. Okay, how many times did we exceed expected move? Did this hold true? If we had a script to do that, well then, wow, we'd be gold. Just absolutely golden. How about we have a script written for that? Okay, and it shows everything you need to know. Shows the number of touches. Shows the number of touches to the upside, to the downside. Shows daily touches. Shows the expected move calculation. Shows how many times we exceeded it. Right now I have it turned off. I can turn it back on if you want. Hit OK, hit apply, hit OK. It's actually going to tell me precisely, okay, the number of times. Under the expected move happened 8% of the time. Over the expected move, and again, I want to highlight this because, you know, you're like, okay, so where's like some of the magic in here? You want to see some of the magic? You can run stats yourself on any underlying. Over the expected move, 18% of the time. Under the expected move 8% of the time. Well, okay, my math ain't perfect, but the last time I looked, we were supposed to be in this range 68% of the time. But only 18% of the time did we go up here, 8% of the time we went down here. What this effectively says right now, okay, this is what we term statistically significant. We're closing inside this expected move over the last 3 years, substantially more than we should. There's edge in that trade. And that blows people's mind, okay? I just spent, 2 minutes, like, showing you the stats. And you go, well, what would be a bad trade? Maybe Netflix, okay? Look, we can calculate Netflix. Everything that Netflix has done. Everything that Netflix has done. How many times? 15% of the time it's over the expected move. 11% of the time it's under the expected move. That still only adds up, though, to 25% of the time in 3 years. That means even Netflix you can sell some premium on. Listen, people, I could go all day. I could just pull underlying after underlying after underlying after underlying. It's good stuff. That's the guide to selling high probability spreads. Okay? And that expected move calculator I just used, it's helpful. Number 3. Now we're going to get to another one. Okay? All right. So, getting to another one over here. Now, so using expected move, first of all, we can zero in on the right position size and precisely which options to sell for weekly income generation. So this is a third class. Obviously, we're presenting classes. Do you think we wanted you to take classes? Of course we do. All right. But, okay, at the same time that, yes, we're presenting classes, right? Do you think it's worth it? Yeah. You don't know what the classes cost. All right. Classes could be worth $10,000 to some people, and they absolutely are. Income, okay, generation on long or short positions. How to collect income being short. So there's a workshop on this. Now, what does that even mean? How to collect income being short? So right now, and this is my personal feelings, okay, I can show you how to collect income being long or short, which means kind of like stuff like covered calls, right? All right, collecting income, I could buy the stock and sell calls against it. Right now, though, I like some of the short positions. I like short positions. What am I short right now? I'm short in CAT. What else am I short? Well, I'm going to show you here in a moment. I'm short XHB. What else am I short? Intel. What else am I short? Okay, listen, I could go all day. I've got a lot of short positions. I also have a couple of long positions, but these are some of the ones predominantly I'm short. I'm also short Morgan Stanley. These are all trades that I've talked about extensively in weekend videos. These are trades that I've talked about on a day-to-day basis, okay, in TheoTrade. But, and again, those happen to be short positions. I can show you how to collect income being short, and you don't have to use a lot of capital. So in this particular class, what we happen to do is we'll cruise over here, and let's actually look at one of the short positions. I'll go over to Morgan Stanley, okay, because I carry a position in Morgan Stanley. And inside of Morgan Stanley, if you look at the position, all I'm using is a deep in the money put. I did not short stock. You want to know why I did not short the stock? Because I'm in a retirement account. I can't short stock in my retirement account. Now I have all kinds of accounts in here, but in my retirement account, I can't short stock. And what do? I buy a deep in the money put, and then I turn around, okay, and I use the expected move to tell me which option I should sell against the deep in the money put. Okay, and I can position size from the expected move. It tells me which options to sell from the expected move. All of that is kind of defined in this particular class. Now, we can also talk about how did I determine that I wanted to be short Morgan Stanley, or how did I determine I wanted to be short Caterpillar? You know, people, they hear all the time. They'll tune into the evening videos that we do here at TheoTrade. And they tune into the evening videos, and then they send me an email. They're like, are you out of your mind? Okay, you're short. Yeah, I'm short, but I'm short Caterpillar. I'm short Morgan Stanley. Okay, I'm short the home builders, and I'm short Intel. Okay, look at them year to date. I don't care if the market's at an all-time high. Right? Pick and choose them. But the only thing is, these underlyings, they're working. Okay, they're working for us, and it's a class on how to actually select the right underlyings. In fact, in this particular class, there's an interesting irony in here. In this class, one of the examples on how to collect income being short, you know what it says? Literally, the example is you can never short Tesla. It says that in the class. You can never short Tesla. It has to do with the market capitalization in there. But here are some of my positions. Okay, the proof is always in the pudding. So this is Caterpillar trades. Now, this is not like an overnight kind of trade. This is something that I've had on since January. In January, I put this position on. That's the exact time of the trade. I paid $25 for that. Then I collected $14 in credits. Then I collected $9 in credits. Then I collected $1 credit. Then I collected another, $4 in credits. Okay. Oh, there's a debit. Wait. I did have a debit. I had a bad trade. I had Caterpillar rally on me for a period of time. Okay. Then I collected another credit. And you know what? I'm still in the trade. Okay. Do you think I've gotten my $25 back? I got my $25 back. Okay. What? Between January and March. Everything else in here, it's all gravy. And now I've got another option, and it's deep in the money. That's Caterpillar. Okay, and all I'm doing is riding the short position and selling premium against it. Next one, XHB. If you don't know XHB, it's Home Builders. All right, in the Home Builders, I initiated this position also on what? January 10th. Now, not all the positions are that long. I paid $3 for it. Paid $3 for the initial position. I got my money back on the first roll. Got more money out of it. More money. Okay, this one, bad roll. Actually cost me $4. Okay, another one cost me. Here's a credit. Here's a credit. Am I ahead of the game? Absolutely. You got to realize I'm putting myself in a position of having $3 of risk. Then all of a sudden, I get that $3 back in the first roll. That makes me in a riskless trade. Who cares? Like at that point, who cares? Yes, I had $3 of risk, but I got $3 credit in the first roll. And the second roll, I got another $2 and another, buck over here. And then like, oh, $4 roll. That was hideous, Don. Absolutely hideous. But it wasn't that bad because I'm still ahead of the game. Then I took in another debit. It's a $5 hit that I just took. It undid all of this. Yeah. Well, then I took in another almost $4 of credits down here. Okay. So again, I got time on my side. That's the XHB. Next, Intel. Intel happens to be a more recent position. Intel ain't nothing to hide in here. I went out and bought, options for $4 and $4.90. I did this in 2 different trades, so I'm in this thing for right around $4.90. Rolled it for a credit, rolled it for a credit, rolled it for a credit. Okay, that's not bad. That's almost what? $2.50 plus $1.80 plus, this is almost like, $3.50 plus $2.50. I'm into this thing for $4.90, and I've already got close to $6 plus of credits out of it. So Intel even becomes a riskless trade. This is the kind of stuff that people need to learn. And these are the trades, by the way, you listen to some of the videos we do at night. All of these trades were mentioned in the nightly videos. Every single one of these trades. In fact, the account that I'm using for these trades, everything is done live. And I do it that way so that not only can you see the trade records, but then you can go back and, it's all archived. It's all archived. It's all part of it, is looking at some of the trades that we're doing. These are a little different though. This is actually holding trades for duration. And you know what? Don't fear the use of options. Yes, I'm using options. Yes, here, I don't even own any stock. I'd be scared to short Intel. I would. It's a big company, right? But why am I scared? Apple's a big company. The thing won't stop. Amazon's a big company. It won't stop. Intel's a big company. Yeah, it stopped. It absolutely stopped. And I use Intel as kind of the litmus test for the entire marketplace. So don't fear the use of options. I'm using them to minimize my risk. But we can show you how and when to place these trades and manage risk around the expected moves in a matter of hours. There's so much to learn around the expected moves. Again, I told you tonight, I'd rather be a little overwhelming rather than underwhelming. And each one of the trades, though, that I've discussed tonight, I kind of hinted to this, but I didn't really get it. You still have to have the recipe for the strategy surrounding the expected move. You have to have the recipe for the strategy surrounding the expected move. The recipe, it's what we call criteria. And all it does is takes you through step 1. These are the options to buy. These are the options to sell. Whether we're actually learning not to use stop orders or we're learning to sell premium, in the way of spreads, all of that has detailed criteria to take you through. Okay. And again, when I talk about like overwhelming people, right? If somebody says, holy crap, I've been a member, right? I have a lot of different stock sites and none of them come close to the amount of information on here, right? And we try to be the best value in trader education anywhere, okay? Bargains are only bargains in hindsight. I love that. What we do here at TheoTrade, it's not just teach a strategy. It's all about criteria. That's what we do, okay? Strategies, totally commoditized. You want to go hop online and somebody say like, I want to learn, this strategy. You hop online, learn what an iron condor is. Okay, you can hop online and learn, you can learn any strategy. I want to learn a double diagonal with a straddle strangle swap, with cheese. Who cares? That's not going to help you make money. What's going to help you make money? Trading, you got to be able to answer the what ifs. Okay, you got to be able to answer what ifs. What if? All right, this, what if that? What if the stock goes up? What's the correct expiration cycle? How much capital do I commit? What strike price options? I mean, the funny thing about options, go to any option chain. This is Caterpillar. This is not even like a crazy underlying. There's a lot of options on those options. right? Do I select 2 days and 23 days or 30 days or 37 days? When I open it up, which options do I trade? That's what answering these what ifs happens to be. You know, we answer the questions. We give you the right probability for my trade. How many option contracts do I do for my account size? When do I close my trades? What if the market moves big? What's the correct return for the strategy? What if the stock rallies massively and I'm short? Can I fix a losing trade? We have the answer to all the trade related questions because we just build you recipes. And in those criteria, in the recipes, it actually has like little flow charts that say, if we move up, if we move down, if we, you know, what if we stay flat? That is what a recipe book should be. Okay. Each unique strategy has each unique variable covered in it. And the secret in everything we do in here, and when we talk about the secret of expected move, well, the secret's always in the sauce, you know, and what that sauce is, again, people can read about these kind of spreads anywhere, but you can't read about what the criteria is. It's about detail. It's about step by step. And for example, you know, one of the classes we just talked about, which is the credit spreads class, you know, it's like 9 steps to be able to enter into a credit spread. But the whole key to the credit spread isn't even entering. It's actually exiting the spread. Because what if it goes against you? What if the stock moves up? When do I roll? We spent years fine-tuning this stuff. Absolutely years. And I'll tell you what, when I spent years fine-tuning these trade setups, okay, it's not just my mistakes. You got to remember, I worked at both Thinkorswim and TD Ameritrade. At the time I was at TD Ameritrade, there were 7 million clients. You know what I did with the 7 million clients? My group actually studied, okay, their trading and their trading habits. We didn't look at like, you know, oh, it's Joe Schmo's account. We didn't do that. But we didn't. We know the pitfalls of what everybody did. And we built criteria to keep you out of those pitfalls of it. And a lot of the trades that we built surround those expected moves. Now, this is what I kind of call the perfect trifecta of classes, right? The perfect trifecta of classes. Essential skills for consistency in trading. Guide to selling high probability spreads, and how to collect income being short. Okay. All 3 of the classes are $691. Obviously have it crossed out for a reason. I happen to be the instructor for all 3 of these classes. Okay. And it really is like, you know, we were talking about this a couple of weeks ago. We're like, what would be like the perfect trifecta? And I couldn't come up with a better, you know, name for it. What's the perfect 3 classes? Okay. This one is risk mitigation. It's how to minimize risk. It's to understand like the logic behind why you're doing certain trades. And we're also looking at the pitfalls and the flaws of trading. But then people want to learn how to sell high probability spreads. They want to learn to get spreads on that have an 80, even 90% probability, okay, in the particular spread. But it's critical that we go through the right criteria and what happens if this trade goes against you. And last but not least, okay, one that I just feel strongly about, I like collect income being short. I don't want the whole world to be long stock. I think that there's some better opportunities right now on the short side of it. And I don't have to hedge around the truth. You know what? Even if you don't like being short, I'll show you, okay, a number of underlines, and I'll show you criteria in this class, okay, on why certain candidates just make better short candidates. And that's a big portion of that particular class. Each of these classes, okay, is over 3 hours. This one's 3 hours. This one's actually 4 hours. Okay. This one's 3 hours. All of them are archived. They're available immediately, 24/7 access. And the class slide decks, it includes the entry and exit criteria, the checklist. You can download them immediately. The other thing is these classes qualify you for a reduced commission rate. Now we have deals with several major brokerage firms. The deal that most people ask us about is with TD Ameritrade. Yes, we have a deal with TD Ameritrade. We are under direct orders. We do not mention how good the commission rate is. Okay, you can feel free though to chat in right now. You can chat in and we will tell you what that commission rate happens to be. If you have a TD Ameritrade account already, that's fine. It can have, you know, an IRA. It doesn't really matter. If you have 10 accounts with TD Ameritrade, fine. If you have an account with another brokerage firm, ask us. We've got commission deals with a number of major firms. Just have a long-lasting relationship with TD. That's completely up to you. Now, as I said, all 3 of these classes, they add up to $691. And I'm going to make this clear. We sold these classes for more than this at the time, okay? But everybody that looks at this is like, oh, I've been there and I've done that. You know, many of you guys tuning in, you've been through the gauntlet of paid classes. Then you had to buy indicators. Like, look, I just showed you an indicator a little while ago. Okay. I have to ask this question. Well, what do you think it's worth for just the indicator? What do you think it's worth just for the indicator? The indicator, okay, took us a very, very long time to perfect, right? A very long time. Like, give me a price. Like, what do you think it's worth just for the indicator? Because that's where people I had to buy the class and then had to buy the indicator and then had to buy the secret squirrel black box and only to find there's just one last thing. But wait, there's more. We've had enough of that crap. We really have. It's garbage. It's educational sales pitches. We put an end to it. Okay. And we're here to kind of disrupt financial education. I want you to remember something. We're built by professional traders. Everybody on this team has a minimum of 15 years trade experience. Okay? They're not professional salespeople. We hire traders. In fact, I'll put a microphone in front of a trader that's never had a microphone in front of him before. That's how we get our instructors. Educating you, though, it's our only goal. I'll prove that to you here. Not just going to demonstrate it. I'll prove it to you. Education is our goal here. All right? And we're going to change the way that you guys view education. We've now got Total Theo, unlimited streaming monthly membership. And what that effectively does, okay, here, unlimited. All right, what it means, you have access, okay, to over, 70 classes. So you have access to over 70 trading classes. They're all available immediately. You have new monthly classes. By the way, we have a multitude of new monthly classes coming out this month. There's going to be, okay, 2 classes in August. I'm not going to tell you one. Okay, one of them is by Jeff Bierman. The other one's actually by Matt. Okay, and hey, we also happen to have a live trading chat room. That is a minimum of 5 hours per day. We broadcast for 5 hours today. Not everybody can do this though, right? So what do? We archive the stuff. Indicators, like the indicator I showed you a moment ago. Okay, what if we just gave you the indicator? Would that be worth it to you? Okay, right? It's $99 a month, but you don't. Once you pay the $99, the indicator's yours. Like, you downloaded the indicator. It's yours. We can't take that one back. But hey, we also email out trade ideas. We have daily coaching sessions with timely topics in stocks, options, and futures. And the instructors here at TheoTrade, we directly answer all of your trading related questions. All of them via email. It's theotrade.com/all. Now, okay, before any decisions are made, it's as if we're giving you $592. Okay, you can go out and you can plunk down $691 on these 3 classes. Some people like to do this. They like to buy a class, right? I want to have the essential skills class, or I really like the guide to high probability spreads, or I want to learn how to collect income being short. How about if all 3 of those classes were just $99 a month? Okay, now you stream. What does that mean? You just pay $99 a month. You have access to everything. Not just the 3 classes, everything. Okay? I present these 3 classes because I think they're the perfect trifecta. And if you know what? Enroll tonight, and if you need the links to the classes, I'll give you the links. Just shoot us an email. I'll give you the exact links to each one of these classes. Okay? But again, there's new monthly classes. There's a live trading room. The live trading room, we trade all day throughout the day. But not everybody can join us all day. And I don't want you to think like, I'm not getting my $99 a month worth. Please. You just get the indicator. Do you realize, okay? You realize some people have paid. If you're listening tonight, some people have paid $1,000 just for a stinking indicator. Okay? How about if we gave you every indicator that we had? Every single indicator that we had. Okay? And then on top of it, right, we also happen to have a live trading room. Oh yeah, and we give you classes. Oh yeah, and it's all archived. Okay. Oh yeah, and we email out trade ideas and then throw some coaching sessions in there. Coaching sessions, it's about 2 hours a day. What that means is of the 5 hours a day that we're streaming, 2 hours of it are heavy into education. Okay. Just finished my very first quarterly trading, reported, 21% return on investment. Fantastic service. Self-directed when my trading through education got it here. Okay. Just want you to know how much I appreciate him, what he does. First time ever my account is in the green. That's where we're at. Okay, this is actually a brand new one. Thanks. Okay, I'm up $4,000 this week. That's the kind of stuff that we want. It's theotrade.com/all. Now, let me actually bring you specifically to a couple of sites on here. First of all, this is Total Theo Unlimited Monthly Streaming. And I'm going to answer a few questions here momentarily. Okay, I want to make it really clear what the web address is. We're here to answer questions. In fact, you can even come in here. All right, I'm going to refresh this right now to show you this, because you can come in here. We're here live right now. Okay, we're in there live, and you can come in and you can ask questions if you need to. It's theotrade.com/all. Okay, what's the all? It's everything. What's everything? It's everything that we do. It's $99 a month. Okay. By the way, people always ask this question. I'm going to hit it right up front. Can I cancel anytime? Of course you can. That's important. The other thing is, you know, with a membership, people freak out. They're like, you're just going to bill my credit card. No, we'll actually email you to let you know that we're going to bill your credit card. We don't like, okay, there you go. So you could chat in here live right now. Okay. We don't like when somebody just bills our credit card. So we don't do that to you. I don't even like when Netflix does it to me. And you know what? The idea of Total Theo monthly streaming comes from Netflix. I don't like it. They charge me, $12, $15 a month. I would rather they email me every month. Well, we do. We email you and say like, hey, we're going to charge you $99. Is that okay? Now you got to realize what we just talked about. It includes the 3 classes that we discussed. It includes everything about expected moves. But if you want to know more about TheoTrade, this is what the TheoTrade room looks like. This is a video player. We don't use this GoToWebinar that we're in tonight. We don't use something like YouTube. We're tech geeks, and we let you know it, all right? So this is actually a class. It just ended seconds ago. Literally, it just ended seconds ago. Corey Rosenblum was doing a class in here tonight. We do Wednesday night. It's called a happy hour, okay? And his happy hour is in here. By the way, you can come in here. You can type in here, hello, okay? And you can see there's my name. It comes up. Anyway, when I type in there, I want you guys to know, like tomorrow morning, you can come in there, chat in the chat room. I kick off, okay, every single trading session. I like to kick it off in the mornings. Now, there's a lot more, though, than just a chat room, okay? Here's a start here. If you're brand new, you've never really traded before, where do you think you go to? You go to the start here. You go to the start here. Why? Because in start here, it takes you through the 101, okay, 201, 301. Then we start to get into crazy stuff like what? What to expect in the markets using expected move and probability. Order execution. That's getting better fills, preparing your trading day. What to watch and why. What products. What should you trade? Getting your risk under control. Okay. All of this is just to get you ramped up for the classes. Okay. For the classes that, let's go into some of the details of the classes. Classes are broken into option strategies, option newbies. Are you a day trader? If you're a day trader, I don't know, click into the day trading classes. Okay, does this work for you? Okay, NASDAQ futures, consistent intraday strategies and setups. That's one that I did. Okay, beginner's guide to trading intraday futures. All of those classes, they're in there. That's just day trading. That's you're like, I'm not into that. Okay, I'm into more investment style stuff. Right? If you're into more like investment, we have stock classes. Okay, the stock classes. It also includes fundamentals. Okay, we have one of our individuals on staff happens to be a fundamental expert, was an analyst for Wall Street and managed a hedge fund. That's Jeff Bierman. So we've got fundamentals in here. All right, it just goes on and on and on. But if you want to learn option strategies, okay, unequivocally, this is the most deep archive in the entire industry. I don't care if you paid $20,000 for an options education, you ain't getting what we have in here. It's $99. Question is, how much of it can you watch in 1 month? Right? There's a lot in here. There's a lot in there. Each one of these is a 3-hour course. And when you come in here, we were talking about one of the courses a moment ago. And one of the courses a moment ago was, how to collect income being short. You want to see this one? Here, let's click on it. Okay? Because what a class really amounts to. As I kind of scroll down, these happen to be the archives. Now it's playing right now. Okay? It's giving you short candidates. This is where you click to download the slide deck. The original air date of this class, right? April 28th, 2018, not half bad. Offloading risk, determining a loss limit. It just goes on and on. The class is broken into 3 parts. Yeah, it's about 3 hours in length, but I wanted you to see what that looked like, okay? Last but not least, there's a member home. What's the member home? It shows you, first of all, how to use the entire site, okay? But it also, okay, walks you through hey, you can search for any topic that you want. Want to learn how to use the Analyze tab of Thinkorswim? Good, done. All right. You want to learn, about vertical spreads. Good. Done. You can search for stuff on the site. All of this is encompassed at $99 a month. And that's why we said we really do want to put an end to all the crap that's out there. Okay. Oh, the other thing, people were asking about shared charts, scans, and studies. Listen, $99 a month. Okay. Even if you pay one time, listen, you have access to all of it. We don't want you. Okay. I want to make something clear over here before I go any further. Okay. We don't want you to be on here for 1 month. That's why we're giving you, $691 of classes for $99 a month. We don't want you to be on here for 1 month. We want you to be a client for life, because you're going to realize kind of what you're getting for $99 a month. It's not achieved anywhere else at any price. That's the important point. That's what we want you guys to kind of recognize. All of it's found, theotrade.com/all. Okay. By the way, one last thing on that front. Yeah, we're also coming out with a mobile application. Okay. Oh, David was asking, is Matt going to teach us Fruit Fly trade? Yeah, it's coming. It's coming. Fruit Fly is coming up. All right. The Fruit Fly trade is absolutely coming up. By the way, you need to get a hold of us right now. We're here. You can actually chat to us. You can call the number 800-256-8876. Okay. Support at TheoTrade. But we do say, add to the cart right now. It's $99. You're not going wrong. Okay. Worst comes to worst. Hey, listen, you sign up for 1 month. We don't do any trials like that. You don't need a trial. $99. We're giving you all the indicators and everything. Okay. If you don't love it after a month, we'll part ways, and, we'll still love you. Okay. And you'll get a great education, but stream. Okay. And enjoy it. Let me answer a few questions that typically come up. The first one that always comes up, is this a membership for $99 a month? And can I cancel anytime? Yes. Okay. You can cancel anytime, but we do bill you on a monthly basis. We do warn you before that. Okay. By the way, you're Canadian. We can talk about commissions. We don't necessarily have a commission arrangement, but I can actually tell you, if you're Canadian, where to go to. The next question that inevitably comes up, people say, I can't get approved for options because I'm new. Our courses will help you get approved. We will get you approved for options. Hands down, we got your back. Everything I talk about, the next question that comes up, can I do this in an IRA? Hey, listen, I'm now trading in an IRA. Okay. I'm in my early 40s, but I did well. We took a company public. It was a good time. I don't need to live off of the trading income. So I trade for income, but I trade inside of my IRA. And I think a lot of people probably do that because they're trying to catch up in there. All right. Simon, yeah, if you want to sign up for a year, just shoot us an email. Okay. We'll give you a discount for a year if you want. I think that's fair. So absolutely. The next thing that comes up. So by the way, yes, you could do this in an IRA. You could do it in a SEP IRA. No problem. All the classes I talk about that. Okay. The other thing that comes up, day trading margin rules. If you're a day trader, I can help you around the margin rules. All right. Somebody always asks, I work during the day. Well, that's why we email certain stuff out. Okay. That's why we actually have archives. You work during the day, and you just don't have the time to put in we're streaming for 5 hours a day. It's funny though, people that work during the day, they kind of glance at, what's going on in the chat room from a mobile device or, their work computer. By that, I mean, they're streaming it on their mobile device. Yeah, you could do that right now. So everything we do is recorded. Another question, actually, somebody just popped in, said, I'm kind of new to this, and it's, can I get my head wrapped around it? One of the things we try to do, and this was Michelle that came in with the questions, one of the things we try to do is to help you get ramped up if you're not new. Because what I talked about tonight, it's overwhelming. I mean, I know it's overwhelming, but, a lot of people go to a lot of different sessions and stuff, and we like to kind of put that nail in the coffin and just say, listen, there's nothing else out there for any amount of money that you're going to find that's going to be on the educational resource level of what we're doing here at TheoTrade. Okay. I've gone on what I would call, and I'm one of the co-founders, but my job here at TheoTrade is it's not just to teach classes. I'm also here to find the absolute best instructors, and I've gone on a hiring binge lately because I look at this like Netflix, hey, your genre might be horror movies, your genre might be, mysteries. I don't know. Okay. If you like cyclical analysis, Slim Miller is the best in this industry. You're a swing trader, Corey Rosenblum, hands down. Okay, the guy smokes anybody else in terms of swing trading. Technical analysis, please, Jeff Bierman. He literally, the guy built the Thinkorswim charts. Okay, then we actually just hired like Brandon Chapman. Brandon, the guy actually writes Wikipedia stuff. He writes the questions, for the CMT exam. The man writes the questions for the CMT exam. It just goes on and on. Okay, Matt has actually managed a huge amount of money for a period of time, and I just go on and on all day about these guys. They're good. I put as much stock in any one of our instructors as I put in myself on being able to teach this stuff. All right. Another person says, again, if you don't have that much time to trade, can I do some of these strategies? Absolutely. Absolutely. Okay. So with that, by the way, somebody said they're having problems with the add to cart. Well, hopefully it works okay over here. The add to cart is working okay over here. I want to make sure, right, that everybody's good. If you're not, try a different browser in there, but it is working on my side. By the way, there is times where we get a little overwhelmed with the amount of traffic, but we have good servers. I'm going to leave it there. I tried to answer as many questions as I possibly could this evening. Okay. By the way, Robert had a question about Thinkorswim. We actually do have classes on how to use Thinkorswim in here. Shh, don't tell anybody. They're called TheoTrade tutorials. So if you're into Thinkorswim, all right, I shall consider myself probably the foremost expert on Thinkorswim. I spent 20 years on there. And yeah, these are demos specifically of Thinkorswim. So if you need those, Robert, they're in there. That's part of it. theotrade.com/all. I want to thank everybody for joining this evening. Have a wonderful evening. Bye-bye.